Good evening, traders and investors. Will back here with another one, coming to you with a Friday and weekly market recap. Hopefully you guys had a very good day on the Friday session, and hopefully you're off to a very nice start to the weekend as well. Now, in terms of Friday's action, the S&P and the QQQs actually put in some gains. It was a very busy week, everything from Jerome Powell to Trump and President Xi meeting as well, to a whole host of big tech earnings in the markets, and overall the week didn't turn out so bad. However, we do have several warning signs, especially in terms of the market breadth. A lot of concerns recently surrounding the concentration in the market, the disparity between some of the short-term negative market narratives and the long-term positive outlooks for the market as well, which is leaving some investors very confused and also very concerned. On the Friday session, we actually got a big red flag indicator, which was the Hindenburg omen, showing very weak market breadth despite the SPY being very close to the all-time highs. This only happens when the market is very close to all-time highs. However, you have more names hitting 52-week lows than 52-week highs. It shows market concentration, and sometimes people can get a little bit fearful when this indicator does flash. It does not happen too often, but can sometimes be preceded thereafter by some market declines. So in today's video, guys, we're going to break down everything for you. You guys know very well that over the course of the past 2 weeks, I've been issuing a few warning signals in terms of the market breadth, the market concentration, and the disparity between the narratives, both in terms of the bearish short-term negative catalysts that we could have, but also the fact that long-term outlooks for the market still look very good. So we will spend the first 10 to 15 minutes going through a whole bunch of statistics explaining the Hindenburg omen and whether it's statistically relevant for the markets, but also going through a massive amount of statistics for you guys. And of course, at the end of all of it, provide some conclusions. Should we be buying still in this market? Should we be trimming some positions? Should we be selling out of everything? I'll give you guys my thoughts on all of the above. Thereafter, of course, guys, we have to cover a lot of earnings as well in today's video. We will be going over 4 companies that had earnings last week. We're going to be talking about Booking Holdings, talking about Mercado Libre, which my big head is in the way, but it was all the way down there. And then we'll be taking a look at 2 companies that really missed the mark, Fiserv and Chipotle. Now, obviously, there's many other companies that I could have covered, but Booking Holdings and Mercado Libre are in my long-term portfolio, and I think they're very high-quality long-term stocks. And then Fiserv and Chipotle, I've got a lot of interest in covering those just because of the size of their declines. So those are the 4 earnings that we'll be covering today. Possibly we can do a couple more catch-ups here on the Monday session. Now, in terms of the rest of the video, we'll be going over the technical analysis of the SPY, the QQQ, and all of the minor sectors as well. Keep in mind, the month of October is now finished. As a result, we have the monthly candle closes. And now with the S&P up for 6 months in a row, the QQQ's arguably green as well for now 7 months in a row. Should we be having a little bit of pause, or is the bull market still very, very healthy? So we'll be doing a full technical analysis rundown of our indexes, see where we stand, check on that rotation. Thereafter, we're going to be doing the same thing across all of our big tech names down here. Which of these companies still represent good trading opportunities and or long-term position buys for longer-term portfolios? Towards the end of the video, if I have some time, because today is going to be jam-packed with statistics, market outlooks, commentary, the earnings as well, and obviously our technical sectors rundown. Now, if I have time at the end of the video, I will do the biggest gainers and losers of the Friday session. However, if we don't have time, I'll jump right into my portfolio for the trades made this week and how I'm positioned into the next week of action. So it's going to be a very action-packed video, should be a fun one as well, and a video that you can possibly reference into the next few weeks. I don't do these very big videos that often in terms of the full statistical rundown of the markets and outlooks and big trade positioning. But when we have certain big indicators that kind of flash some warning signs, you really have to do a bit of a deep dive in the market and come to a conclusion and what is best for you as a trader and investor moving forward through the volatility. So let's get right into the action, shall we? The SPY up 0.33, the Qs up 0.48, but we know the market breadth has been a concern once again. Very awkward price action on the Friday session. Sure, Amazon, Tesla, Oracle, Palantir were higher, but we're missing Microsoft, Apple, Google, and Meta, and even NVIDIA and Broadcom coming down. A lot of the tech sector, very mixed. The financial segment remains excessively mixed as well. You can see the banks did well. The credit cards did not, despite MasterCard and Visa reporting very good earnings this week. The insurance players and some of your financial data segments also not performing the best. Healthcare over the course of the day was once again a mixed bag. Consumer defensives continues to be one of the weakest points in the market, as just nobody wants these value names in favor of all the growth and AI names out there. And the bottom half of the market, extremely mixed as well. If you even take a look, guys, at the past 1 month performance, you'll see a lot of green as a result of some of the earnings moves and NVIDIA's GTC conference, which you covered last week. But look at so many other aspects of the market, right? The bank's doing good, credit cards not so much, insurance players and financial data segment in financials getting smashed. Healthcare, very mixed bag as well, depending where you look. Communication services, I mean, Google's doing good. Meta, down after earnings, and then the rest of the sector just missing. Consumer cyclical, largely Amazon and Tesla only at this point in time. The rest of consumer cyclicals, nowhere to be found. Defensives, very mixed, and even the bottom half of the market, guys, extremely mixed. So as a result, now you know why we have some breadth indicators that have been flashing some warning signs for the past 2-3 weeks, which we've said on the channel, but now they're flashing even bigger warning signs overall. On the one-day relative, you can see that consumer cyclical had the outperform, but that's largely because of Amazon's huge day and Tesla carrying as well. That being said, that was the only aspect of the market that did very well. Everything else, extremely mixed and very choppy price action. In terms of fear and greed, we still remain in a fearful environment, and that's because of the market breadth. The market momentum is not that great other than a few target companies here and there related to AI. But, stock price strength, guys, net new 52 weeks highs and lows, down, and it flashed the Hindenburg Omen, and stock price breadth as well as measured by the McClellan volume summation index, also down. And we've noticed a shift since the end of August into early September with that non-farm payrolls report, right? We've had some good news since then, especially in relation to earnings, but we have had some very awkward economic releases, at least the ones that we have received now that the government's been shut down. So before we move into more technical analysis and make sense of all this on the charts, we're going to have to go through, guys, a bunch of statistics, and we're going to start it off with the infamous Hindenburg Omen. So you will see that this is a market breadth indicator, and it's flashed many times over the course of the past 15 years. You will see that sometimes the hit rate is really good. You can notice some big hit rates here prior to the COVID sell-off, some other hit rates prior to the 2022 bear market overall, but many other times it just flashes some warning signals. You'll get some slight drawdowns in the context of an overall bull market, like back in 2014, etc., 2017 as well. We can look at 2013. It flashes. We have a mini dip, 5%, 7% on the Qs, and then we kind of just resume the bull market overall. But a few times, such as 2020, preceding 2020, 2022, and even once or twice right here before the tariff incident this very same April, those led to big declines. As a result, it's very tough to determine whether or not this is going to be a slight pullback, no pullback at all, or a very big correction. That's the problem with statistics, right? The variance is quite large oftentimes. You'll see that even better on this chart right here. The first two columns are 1 week and 2 weeks later after the Hindenburg Omen. This chart measures since 2018. You can see in the first 2 weeks, it's fairly mixed. If you move out to 1 month and 2 months out later, though, then the hit rate starts to be a lot more positive. Now, there are certain exceptions here, like in November of 2019, where the market just stayed green, in March of 2021, where the market also just stayed green. But you notice, right? 1, 2, and 3 months later, the hit rate is a lot higher. Then we get through a temporary correction. 6 months later to a year later, then it starts to be a little bit better. But as I said, guys, it's tough with statistics because you're never sure which of these scenarios you should closely tie the current market into. The variance is quite large. So rather than focusing on statistics like this, let's look deeper into the data, shall we? And there's a few things here that should be notable to us. Since the non-farm payrolls came out early September, the market has not been the same. And I've been commenting on this. You might remember I was talking about this while I was traveling in Asia, to where the positioning was starting to get very awkward. It was basically AI versus everything else. If you are not in AI, it's just not working, and your returns will not be as favorable as the people who are heavily concentrated into AI. But this variance is starting to be very large. AI has been up 16%. This is a basket of stocks, of course. Consumer cyclicals down 5.5. Prior, they were tracking, right? AI was outperforming, but the rest of the market was there. You might remember me talking about this for a while. Coming out of the April lows here after the tariffs, we had broad market recovery. But then into early September, we started losing so many different sectors. And that looks something like this: relative strength of certain sectors versus the S&P 500 over the past year. Focus on the last 2-3 months worth of trade. Communication services has been doing well, but that is largely a byproduct of Google, Meta, and Netflix being such heavyweights in that index. However, take a look at everything else. Discretionaries down, guys, over the past 2-3 months. Staples down and out. Energy down and out. Financials down and out, except for the banks. But broadly speaking, that category hasn't been doing very well. Visa, MasterCard flat over the past 5-6 months. The insurance companies down. Financial data companies like SPGI, Moody's, FactSet, a whole bunch of companies down. Healthcare down. Industrials, well, not down, but down in relation to the S&P because of the fact that there's only a few large weights in the indexes pulling the S&P higher. But broadly speaking, it's not too good. Industrials down, materials down, real estate down, technology, there it is, right? Higher, and utilities down in relation to the S&P's performance. Look at this even better, guys. The top 10 stocks now account for 41.4% of the S&P 500's market cap. Yes, they are the most profitable companies on the planet. Yes, they have some of the highest growth rates, but still highest levels of concentration that we've seen over the past few years. 41 AI-related stocks now make up 47% of the S&P's value. The chart looks something like this since last year. It's been growing and growing and growing, partially because the big tech companies have been posting very good ROIs. But this gets magnified when the rest of the market is nowhere to be seen. Moving on further, market breadth and concentration. We are now below 1 standard deviation of our standard breadth. Keep that in mind, guys. So a lot of different warning signs here and there in terms of concentration, in terms of breadth, in terms of overall sector performance versus the S&P. It's not just the Hindenburg omen, right? You can find several different statistical pieces that'll show the exact same thing. Moving on further, this is a chart of some companies that you guys may know very well, a lot of them in the value and defensive sectors. Now, you can make the argument that these companies are down year to date because they have very old school business models. They're dividend paying companies. Nobody wants value in a tech and AI focused bull market. And overall, that may be true, but some of these year-to-date performances are quite staggering, and some of them aren't even here. We can talk about UPS, we can talk about Target. A lot of these companies do have their own execution problems. This is true, but usually you do not see such a very wide variance. A lot of these companies have pretty good dividend income rates, right? However, if you just take a look at broadly, one of the best dividend income ETFs in the market, arguably, since 2021, this has been flat. And most notably, since the end of 2024, it's just been down. Now, if you were to adjust this for dividend reinvestment, we are higher, but you would also like to get some equity appreciation as well, and not only have some gains because you're reinvesting the dividends. Hopefully that makes sense. Moving on a little bit further in our analysis, we have some diverging statistics. So I showed you the bad, but you can also cherry pick other statistics as well. When the S&P is up more than 15% year to date, heading into November, it turns out that November does even better than normal, 2.7 versus 1.9. And if you measure the last 2 months of the year, because we know we're heading into a bullish seasonal period of the year, November and December, but keep in mind, September and October were supposed to be seasonally flat or bearish. It ended up happening that we had some of the best months of the entire year in September and October. However, that performance was kind of concentrated. However, it is notable to us that we have to show these statistics as well. Overall, November and December have been very good years when the S&P is up 15% year to date, which it is. Statistically speaking, you have better odds of having a good November and December, or a combination of both, than you would have negative. Only 1 year in which we saw the last 2 months of the year return a negative performance, and that was in 1986 when the S&P is up 15% year to date. So see, I could take some negative statistics and show you guys that the market is possibly going to sell off, but then I can take some positive statistics and show you that the market's going to go up. Don't worry, I'll provide my conclusions at the end of this analysis. Moving on here, we also have other things that are happening in the economy, right? Total share of the population in economic expansion. Well, we're seeing a big problem right here, right? The problem is the fact that, for the most part, right, we are seeing that 82% of the US population lives in regions experiencing an economic recession. the highest share since 2020. Now, this might come down to some of your anecdotal experiences as well. Maybe some of your friends and family are saying, listen, my paychecks aren't going as far as they used to. Things are expensive. It's tough to find a new job. The wages, real wages aren't increasing. That might be true, right? But this statistic is quite notable to us, to where the total share of the population in economic expansion is excessively low. Just something that you have to pay attention to. All these anecdotal pieces that we've been building for the past year of consumers being a little bit stretched, a little bit pinched, and just not feeling too good about the economy. Well, if you take a look at this analysis, that is definitely true right now. But obviously certain other pockets of the market, like high income demographics, are doing very well, which is why I keep saying, guys, it's a K-shaped economy. The top income brackets are doing really well. The middle class is just not moving, but they don't feel too good. The lower income cohort definitely pulling back on spending and not doing the best. Moving on further here, guys, there's more. The top 10% of wealth accounts for 50% of consumer spending. Now, some of you might push back on that and say, yeah, well, that's always been the case. Well, yes, but it's getting a little bit more magnified at the current rate, right? Your top 10%, which is the middle column and down towards the top 1%, they have 30.8% of the total wealth, but they represent 50% of consumer spending. Now, of course, a lot of this, high stock prices, may play a key role in this. And Jerome Powell was asked about this as well during the most recent Fed meeting. Now, his answer was very political in nature, saying, well, you know, if you look at studies, any marginal dollar worth of increase for those people is not going to lead them to necessarily feel more rich because they're already rich. Makes perfect sense. But the disparity is definitely here and definitely becoming more and more present, to where the market right now is a question of, if you own assets, if you've owned assets since 2023, you probably don't feel too bad. Even if prices are rising, your net worth is probably rising as well. If you own a house and if you own stocks, you're doing well. If you don't own any assets at all, you are really struggling in this current economic environment right now. Moving on further, we talked last week about all of the recent layoff announcements, and this could possibly be a precursor to more layoffs coming in the future. Now, there's a bit of a silver lining here, right? Some of these names have been benefiting from AI gains, and as a result are seeing efficiency gains, productivity gains, and can afford to lay off employees, such as Amazon. Other companies have been having execution problems for years, hired too many people in 2022, thinking the business was going to keep flying, and unfortunately that was not the case. We can reference UPS, we can reference Intel, we can reference Accenture, which lost a lot of government contracts after Doge. So some of these are execution problems, not necessarily the sign of economic collapse or things of that nature, which is why Jerome Powell last Wednesday said, we're currently in a no hiring, no firing economy right now. There's still jobs available, but companies aren't necessarily increasing the amount of people that they want to hire. If anything, they're trimming down, not necessarily because they don't, or they feel economic pressures on their margins. No, just because they either hired too much in 2021, 2022, and they just don't need as much personnel, or other companies just have execution problems and they have to cut costs as a result. But you cannot say that it's broad-based right now. Looking at more statistics from the consumer, right? Your anecdotal experience might tell you that, well, people are struggling right now. But what does the official data say? And you may not agree with the official data, but the market is only looking at the official data. It does not care about anecdotal experiences, right? So in terms of consumer spending, we are still seeing relatively strong numbers. Now, we do not have the September number because the government is shut down, of course, but the past 4 months or the past 3 months shows consumer spending still being resilient. And we saw that when we took a look at the bank earnings, Visa, MasterCard, and American Express. Those are better retail indicators, of course. Moving on further, personal income. Have people been getting better or worse off over the course of this year? The past 2 months show 0.4% in terms of expansion, which is better than the inflation rate. So people are gaining in terms of real wages versus the rate of inflation. But as I've always said, it does not happen too fast. However, the market is looking at these two things. Unless these two things flash big warning signs, it's not going to include that in the bear case scenario. Makes sense? More statistics. I told you guys it was going to be a huge video, right? We covered this a few days ago where we said 195 companies have reported so far, which was 40% of the S&P. 85% are beating the estimates, but there's a disconnect. Even though a lot of segments are beating the estimates, they're not getting good performance since September, right? If you take a look here, cyclicals, technology, and communication services are some of the only ones that have seen good performance. But that's not because their earnings are bad. percentage of companies beating earnings, look at all these numbers across all of your various S&P 500 segments. You would think that if the market is selling off, or rather the market is lacking breadth and concentrating into AI and big tech, it's because all the other companies are just dying on earnings because the consumer is quote unquote dying. That's not actually the case. All the other sectors are reporting good earnings, but they do not have good relative returns over the course of the past 1.5 to 2 months. Moving on further here, broad market statistics. How are people positioned in this market at the all-time highs? Well, you would assume, since the markets are at all-time highs, positioning should be quite high. That is indeed the case. However, right now, we're running very hot. The S&P price index as a percent of its 200-day moving average, meaning how far are we away from the moving averages that matter the most? You'll see here that we're coming into some of the top end of the ranges here. Can it go more? Of course it can go more, but I've been highlighting this, guys, right? The S&P, I like to use the monthly moving averages because you can see it a lot better on the chart, right? When you move too far away from the 12, you get some corrections. Whatever the reason is, eventually something happens to where the market does normalize. So as a result, right now, we are very far away from this 200 EMA, which consequently is a very close proxy to the monthly 12. And whenever that happens in most bull markets, 2021 was somewhat of an exception, but in most bull markets, something happens to where we do pull back and consolidate towards the 12 EMA. What will the catalyst be this time to make that happen? Well, that's what we're trying to determine through this analysis, right? Moving on further, in terms of your bullish bear ratio, right? Bull bear ratio right now, some of the highest reads we've ever seen over the course of the past 30 years. Can the market keep pushing higher? Yes, but this is just another small little red flag to add to your analysis. As you can see, they are mounting right now, right? Moving on further, Bank of America private equity client holdings as a percentage of assets under management. How is the positioning of Bank of America clients? 66% of them have very high allocation to equities. The only time we've seen that previously, late 2021, and you guys know what happened thereafter, and prior to that was about 2015, 2016. So we are at the top end of the range. Can it go higher? Sure. Can it also lead to possible market corrections because the market is overcrowded to the long side right now? Sure as well. Moving on further, we also know that recently CapEx by big tech names has been the focus point of a lot of discussion. Where are the revenues? We don't necessarily have that many revenues yet, right? Amazon, Alphabet, and Microsoft are seeing productivity and efficiency gains, which are translating to good cloud service revenues, right? But dare I say, guys, I mean, well, not dare I say, it's just fact, right? Of all the money that these companies have spent, these companies used to be very highly investable for most people because they were CapEx light companies. They used to do a lot of buybacks, high margins, high free cash flow. That cannot be part of your thesis right now. Now they are spending heavy, right? Have these companies, with all of their hundreds of billions of dollars in AI spend, have they recuperated their investments yet? No. Arguably, we're at the early stages of seeing that translate into revenue. So keep that in mind. Moving on further, the US real GDP growth contribution from tech CapEx. As you can see right here, real GDP is GDP minus the inflation component, of course. You can see here that tech CapEx has been upholding GDP, but the contribution from the rest of the economy has been going slightly down. Now, I do expect this is the numbers as of 2Q, right? But the US government has been getting a whole lot of foreign direct investment. And of course, the investment portion of the GDP ratio should be contributing a bit more and more to the economy, right? But as of right now, private corporation CapEx is a big component of keeping the GDP somewhat artificially high. That is something we know. And last but not least, I'll remind you guys of the average length of a bull market. So we have a lot of short-term negative catalysts. We'll derive the conclusion soon, but I'll remind you, right? The average length of a bull market should be in terms of years. We had a nice bull market from late 2022 through 2020, early 2025. We got hit with the tariffs. Now, usually you need 20% down on the SPY to actually trigger a bear market, but I'm willing to actually include that. This is what Tom Lee says, that we've had a few market clearing events over the past few years, and we haven't really got a long cycle of expansion without having a 20% drawdown. And as a result, if you're a long-term bull, you should still be very bullish on this market since we've already had a 20% correction over the course of this year. Obviously, the signs in the economy are not degrading just yet. So through all of those statistics that I've just brought to you guys, obviously we can see that there's a lot of red flags. And I'll bring you guys the thesis once again. we have short-term bearish narratives at play, but we also have long-term bullish tailwinds, and I will recap them really quickly. We have the fact that the AI bubble and the market is overvalued are two things that people keep talking about right now. Breadth and concentration risk obviously accentuates this bearish narrative. Now, if you ask me my opinion, are we in an AI bubble? No, we're in a acceleration period for the markets, which we do see once every decade or so. I wouldn't necessarily call it a bubble just yet because we're not trading at bubble valuations, and these companies have very real revenues. Now, there's the whole circular investment argument between OpenAI, NVIDIA, AMD, back to OpenAI, through Oracle, through Microsoft, back to OpenAI. I get it, right? But overall, these will have real-world impacts in the future. The question is, though, in my opinion, is have we possibly priced in a lot of the growth, a lot of the efficiency gains, a lot of the money that they'll be making from AI? Have we priced all of that in too soon? The answer is possibly yes, because a lot of these companies, not big tech, but a lot of the data center plays, the quantum names, all the ones that are running hot, right? The AI trade, a lot of that trade is currently trading at 2028, 2029 multiples of revenues and sales. So we've pulled forward a lot of the growth right now. Now, I agree with you. That is what the market usually does. But sometimes that can be problematic because it gets harder and harder to find new buyers willing to pay for those extended growth rates. Moving on further, the technicals are stretched, which we talked about already. Distance from the 12 EMA on the monthly and the 200-day on the daily, right? Government shutdown. The problem with the government shutdown is that although it hasn't had a market impact right now, we're missing a lot of data that the market usually trades off of, right? The market doesn't trade off of anecdotal experiences or smaller data. No, it trades off the big ones: non-farm payrolls, personal spending, personal income, employment rate, right? So we might just get a data dump when the government shutdown ends, and that might be the bearish catalyst, because if we get a data dump, then, right, the market will respond to all that data instantly. And we know that the jobs market has been somewhat soft, right? And that economic output in terms of manufacturing, services, et cetera, hasn't been the best. So be very mindful of this one. Jobs creation is softening. We know all that. I showed you guys the slides since September, right? What the market's done. The consumer status. We have conflicting data at the current time, guys, right? The banks, Visa, MasterCard, American Express, say that everything's fine. However, most data points are good as well. Income and spending, which I just showed you. These two are good. What's not good is how people feel, your anecdotal experiences. The feelings surrounding the consumer are bad, right? And we heard from Chipotle, we heard from other consumer-facing stocks. Discretionary spending has been a problem now for about a year. But when does a problem turn into falling off a cliff? Not yet. The banks and the data points do not show that yet, but the concern is starting to build. It's like a mini snowball. Now it's turning into a medium snowball, right? We also have new risks of private credit and bankruptcies, which we saw in the markets 2 weeks ago. The banks still say that it's not a problem and that you're well capitalized, but a few more of these, this narrative will come roaring back. And China tensions, that used to be there, it's kind of offline for now because we just had a deal obviously announced last week. The bullish tailwind, so this is all short term, right? Extended market, low market breadth, high concentration, any one of these that fires off, they'll be enough to take you down for sure short term. But long term, right, what we focus on, we look at this slide right here. Do we have the juice? Do we have the points to possibly make it out in terms of the long term if we do have a short term correction? Well, the answer is yes. We have strong GDP, but once again, you're getting the 0.4% boost from AI. But that is real money. The AI spend, right? All these data centers, good for construction jobs, right? Good for manual labor jobs, good for a whole host of other companies. We also have rate cuts at the end of quantitative tightening now, and then quantitative easing coming in December. We heard that last week from the Federal Reserve. This is a big data point for the markets, right? It's very tough to fight the Fed in the context of a rate cutting cycle. You do still have low unemployment. This is true. It's a no hiring, no firing economy. Unemployment rate is still low. Is AI possibly going to take away jobs from the market progressively over the next few years? Yes, but are we going to see a short-term explosion in the unemployment rate short-term because the economy is collapsing and companies are firing people by the millions? No, right? So it's not always black and white. It's always gray. You got to see through the noise. You also have lowish inflation, although sticky at 3%. This is true. Should be a one-time increase from the result of tariffs. You have very strong earnings. As I showed you, 85% of all companies are beating on revenue and EPS. That doesn't mean that their stock price has to go up, but are the fundamental numbers good? Yeah, we're not seeing too bad numbers at all. You have the infamous AI megatrend with the economic acceleration as a byproduct, meaning it's not a bubble yet. And now lastly, don't forget, you got $4 trillion worth of corporate and personal tax cuts coming into the next year. So short term, you can have any one of these catalysts come alive and start putting some short-term pressures on the market, especially the concentration risk and the lack of broad market positioning. And then you also have, right, the government shutdown data dump, right? So keep that in mind, right? It seems as though the markets are just waiting for something to happen. People are reluctant to position too heavily up here. They're waiting for something to happen for a market sell-off to then be able to position further for this, your long-term catalyst. So now that we've explained everything, the bullish parts, the bearish parts, the statistics, what do we do with all this stuff, right? That's the big question at play here. So I've summarized some of the conclusions. The conclusion, the metaphor that you always need to ask yourself at different segments in the market is, are you driving your Ferrari in the sun or in the rain? You have to know, guys, in the markets, when the sky is clear, you don't have any negative catalysts ahead of you, the market breadth is very good. When do you go all out? When do you put your foot on the gas because it's a nice, bright, sunny day? When do you slow down because it's currently cloudy and or raining and you are driving a $500,000 car on summer tires, right? You're not going to drive a Ferrari 300 kilometers an hour down the Autobahn if it's fully raining and you're running on slick tires, are you, right? So how risky do you want to be with your $500,000 car now that it's raining? That's the good metaphor, right? Everybody is different. I'm not going to tell you guys what to do. My purpose of these videos is to provide context so you guys, depending on your bullish or bearish skew, can adjust your positioning. Everybody's different. Some people are working with 50, 100K or less. Some people have high 6, 7 figures. If you guys just don't care about any of the risks because you're going for it, let's say you're young, mid-20s, mid-30s, you only have a $50,000, $100,000 trading account, and you're saying, listen, I'm just going to go for it. It's a roaring bull market right now. I'm going to concentrate in the AI names. If I make it, I make it. If I get crushed, if I lose half of this, I don't care. I'm young enough and I make a good enough salary at work that I can make it back. I get it. I completely get it. But that's you. If you have very high 6, 7 figures, low risk tolerance, you've made a lot of money this year, maybe you want to start going in protection mode when it starts raining. I completely get it. Yeah, your age is also a factor as well. Somebody who's in his low 20s, early 30s, who has the next 25, 35 years to make back the money on any short-term drawdowns. If your call options go worthless, you're going to have more risk tolerance than somebody who's mid-50s, mid-60s, or possibly more, that's sitting on high levels of money, who maybe doesn't want to take those risks when it's raining. Income versus obligations, right? Somebody that's retired and working on limited income maybe doesn't want to take a huge cut in their portfolio. They'll be more defensive, right? How many obligations do you have as well? Is your house paid? Is it not paid? How many cars do you have, right? Income versus your expenses or obligations matters a whole lot. Somebody who's super young, working in tech, making 200, 300K a year, you got a 300K portfolio, maybe you still want to keep full risk on, full concentrated into AI. And you say, listen, I make so much money a year. If my portfolio drops a little bit, I'll just contribute even more money from my salary. That's fine. Everybody is different. Do you work a W-2? Are you a real estate mogul? Do you have a business that provides heavy amounts of cash flow? The amount of money you can contribute back to your long-term portfolios or your trading accounts is going to matter a lot. As a result, do what is best for you in light of the fact that it's currently raining right now and the narrative is not so clear anymore. The AI megatrend narrative is very clear, but this market is going to move in waves. It's not going to go straight up all the time. So keep that in mind. When it's cloudy or raining, you have to adjust your positioning. At least most people will. If you ask me what I'm doing right now, well, here's how I see it. We made an absolute ton of money this year on all my accounts, on my long-term portfolios, on my big trading account, even in this small YouTube portfolio trading account that I run for you guys. Now, for me, it's time to keep it. I wound down a lot of my speculative leaps, the out-of-the-money ones that we made a ton of money on over the course of the year so far. I'm keeping other leaps that are in-the-money leaps with 2027 expiries, but all of my speculative out-of-the-money leaps are now closed. I've been progressively winding those down over the past month of trading as I've watched market breadth decline. And I have not re-entered these despite lower prices. Names like Affirm, where I clipped these call options down here, sold them way up there. The prices decline, I'm not buying them back. Rocket Mortgage, even though I love this stock, took some call options from here to here, I'm not buying them back just yet, right? Other names like Oscar Health made a lot of money, bought Oscar Health leaps here, closed them up here, out of the money call options. I haven't bought them back. K-Web leaps on the China expansion trade, we position early 30s. We close them up here, almost at the top. Even though the market's declined a little bit, I haven't bought them back, right? And so many other names. Other names that I've been riding, I've clipped out. Micron, we bought the calls down here. Clipped out, and I'm riding like 2 out of 10 contracts. Google, same thing. Clipped the lows on Google 165, closed some here, closed one last week. Now I'm literally running 1 out of 5 contracts in 2027 expiries. Other contracts that I've recently opened in the past month on high quality businesses such as Amazon, such as Visa, I'm keeping those. They haven't ran to target, and I literally have until June 2027 or December 2027. But everything that's ran a ton, I've either gone out of completely or heavily clipped out of those positions. So that's what I've been doing for some of my longer duration call options, right? We've also freed up a tremendous amount of buying power from our wheel positions as well. 40% in cash, guys, in my big trading account, and not really looking to position on the wheel aggressively. No, waiting for the highest quality setups on the highest quality names, and now 30% of cash in the YouTube trading account as of last week. Started winding down a lot of the wheel positions. Some of our assignments we got called away. I'll be very patient in terms of positioning. We've made a lot of money this year. Now it's time to keep it. And as a result, I already told you guys about the leaps. We just talked about that. I'm keeping the 2027 ones that haven't ran that much so far. High quality, high conviction names. When even names that 2027 I have come in to take profit targets like healthcare, got some healthcare leaps down here. This was TP1. I closed half of my positions there. And now we're pending on the rest, right? So I've been clipping out, opening far less new positions than the amount that I've taken off the table so far because it's raining and it's cloudy. That is everything that I had for you guys in the first segment of the video. I didn't really waste any time at all, right? I know I've been talking about this for 30 minutes, but I literally didn't skip a sentence. I didn't start talking about random stuff or whatnot. It's all just been big statistics, conclusions, and what could possibly be best for you. So hopefully you guys enjoyed that segment. It takes me a long time to present that segment and to prepare those types of segments. So if you enjoyed them, for sure, kind of drop a like on the video and maybe subscribe if you're new. I never say that in the middle of a video, but now I might lose a few of you before we get into these earnings, right? So we're going to cover 4 companies for earnings now that we're through all of that. I told you guys it's going to be a huge video today. I don't know if we're going to get time to do the biggest gainers and losers, but I want to cover these earnings because I think that there could be some nice opportunities herein. So let's get into our earnings plays right away. And we're going to start off with a very nice one, which is going to be Booking.com, one of your largest travel operators in the world. And we know that consumer discretionary spending has been bad on things like eating out and on things like apparel and goods and furniture, right? But it has not been bad on travel. That has been a secular trend over the course of the past 2 years. People still want to spend on travel. Is that still the case? We heard from some of the airlines a few weeks ago for their earnings. They said yes. What about Booking.com, who has all the flight data, all the hotel and accommodation metrics as well? Well, guys, they absolutely smashed their earnings and had really good guidance. Beat on EPS by 3.81 and beat on revenue by 3%. Let's take a look at some of the numbers. So some of the easy numbers for Booking.com. Revenue up 13% year over year. EPS 19% year over year. Fantastic. Room nights 8% and gross bookings 15% higher, which is very good. Now, the company smashed all of its expectations. The prior Q3 guidance has been beaten all across the board. Room nights growth was expected to be about mid-4s. It came in at 8. Gross bookings growth, 8 to 10, came in at 14. Revenue growth, 7 to 9, came in at 13. And adjusted EBITDA also beat by about $300 million, which was excessively strong. If you take a look at more of the beats overall, right? Look at the guidance, right? The actuals versus their guidance. The guidance is still going to be quite good. Room nights going to slow down a little bit, 4 to 6. Gross bookings growth 11 to 13, revenue growth 10 to 12, and adjusted EBITDA between 8 to 14, which was really good. This was better than the previously established guidance, guys. If you take a look at the end of the fiscal year, right? Old guidance, room nights, they didn't provide 7%. Still strong numbers. Old guidance for 2025, gross bookings growth, low double digits, now 11 to 12, same thing. Revenue growth, low double digits, now 12. Adjusted EBITDA growth, mid-teens, adjusted to 17 to 18. So guidance raised, my big head's in the way, but guidance raised on all 3 of these metrics overall. Booking.com, phenomenal company. We'll go through some of the earnings slides. We won't spend too much time on it. If not, this video will be 2 hours long, but I just want to show you some of the stats. Trailing 12 months revenue, this company's never had a problem building revenue, and this time is exactly the same, looking extremely, extremely strong right there. Decent net income metrics for the company as well. You're looking at 30.5% net margins. Now, they did invest a lot recently in their business, modernizing the UI for a lot of their subsidiaries, and you can see this margin curve right here. It went a little bit down when they're investing a lot of money on sales and marketing earlier on in the year. And now we are back to very solid gross margins, something that they did have over the course of 2024 as well. So margins now being recaptured by the company, always a very good look. Q3 room night guidance exceeded the high end of the expectations, 323 million nights for the company, which I'll remind you was 8%. Europe up high single digits, Asia low double, rest of the world low double, and the US up high single digits, which was better than their initial US guidance during the whole tariff sell-off in April when a lot of people were kind of boycotting travel to the United States. Now, of course, we have alternative accommodations room night growth outpacing total room night growth, which is something fun, right? So here's total room growth in terms of the blue line right there, and alternative accommodations, otherwise known as your vacation rental homes, right? So very strong listings, nevertheless, very strong bookings. Mobile app mix continues to increase over time. They've been doing a big push for their mobile apps. They control a lot of different subsidiaries that you guys may know, such as Kayak, such as Agoda, which is really popular in Europe and in Asia and even Latin America as well. You can see here that now mid 50% from high 40s in 2023. That's a really big push in terms of your sales mix and where the numbers are actually coming from, right? Gross booking guidance exceeding high end, very, very strong numbers right there. So all we're looking for here is progressively up and to the right for this business overall. Revenue growth, we talked about it already, right? A bit of a, cyclical, right? Q4, Q1 tends to be lower. People travel a lot more in the summer months, of course, which is why some of their best quarters are Q2 and Q3. And adjusted fixed operating expenses grew 10%, which is slower than revenue. Now, that's obviously what you want to see. You want to see the company have operating leverage, growing revenues faster than the expense profile. And the company did show that as well. And additionally, guys, the best aspect of this company is because they generate so much free cash flow, they take it upon themselves to return a lot of that to the shareholders. You can see the amount of free cash flow that they've been generating over the past 4 quarters. I told you guys that Q4 was a big spend quarter for them in terms of technology spend and sales and marketing. And now free cash flow is kind of returning to average standards here. Now, they had a 1.4 billion. It would have been higher, but they said there were some deferred merchant bookings, of course, which will be realized in the forward quarter. Look at this capital return in terms of share repurchases and dividends, right? Very strong capital returns by the business, which means their shares outstanding chart should look something like this. Look, this is Booking.com's total shares outstanding over the last 14 years. Steady down and to the right, which is exactly what you want to see. It helps them improve EPS, giving back to the shareholders, of course. So Booking.com, really solid numbers. And I did listen to a portion of the earnings call. CEO is quite bullish on travel, saying, people are still choosing to spend a lot of their money on travel. Some people have deferred their purchases from traveling to the US. But what he always says is that, listen, those people are still looking to travel. So instead of going to the US, they may be going to Mexico, they may be going to the Caribbean, they may be going to Europe, or they may be going to Asia. But the fun thing about Booking is that Booking gets that revenue anyways. Whether people travel to the US or anywhere else, if they're still doing it on the platform, they will get that revenue. And so far, they have. So the big question, as always, is this company a great investment at about $5,000 per share? Now, keep in mind, you can always buy fractional shares. You don't have to buy round shares, so you can invest only a couple $100s if you want. The valuations right now on Booking are some of the lowest that we've seen in recent times. In terms of forward 2026 price to earnings, they're trading at a forward 19 for having revenue growth rates of 8.5 and EPS growth rates of 16.5 per year, which means their PEG ratio on average, right? If we take the EPS growth rate on average through 2028, is a very low 1.16. This is exactly what I want to see when I'm looking to pick up high quality companies that give good shareholder returns, that have very strong competitive advantages. This is the biggest travel operator on the planet, right? Very strong EPS and consistent, very strong revenue growth and consistent, a relatively strong balance sheet as well. They do not employ too much debt to do what they do, right? In terms of their debt profile right here, you'll see they do have a decent amount of debt on the balance sheet, but look, the amount of free cash flow they bring in per year and the cash that they currently have on the balance sheet is very strong, and that is the same as of the most recent quarter. So the balance sheet's good, forward growth expectations are good, the valuation is low, and a 5.07% free cash flow yield. all things that are very good. So Booking.com right now, in spite of having very good trends behind the business, right, is only up 1.74% year to date. This company usually outperforms the S&P, but not this year. This year from the highs, they're down about 13-14% with such strong metrics. And the company saying, listen, travel is still a very good secular trend and their consumers still being strong. I do really enjoy this business and I will be buying more shares down here at the $5,000 range. That's everything for company number one, Booking Holdings. As I said, I'll be going through these a bit more quickly. We'll be covering company number two right now, which is a fan favorite that I get a lot of requests for on the channel, also a company in my long-term portfolio, and that is Mercado Libre. So Mercado Libre coming up after earnings about 7-8%. And we know this company hasn't been doing so good since the month of May. Now, keep in mind, this business still, over the course of the year-to-date period, is up 35.6%. So you can't really complain too much, but it's been selling off, right? The second half of the year, not too good. And that was because of a few political issues in Argentina, et cetera, et cetera, et cetera. Some news headlines, but nothing specific to the business. Quarterly revenue beats by 2.6%. However, earnings per share miss by 8.7% because of a few one-time lined items. It's been a common theme this quarter so far. Shout out to Netflix, shout out to Meta. But this business, guys, is still excessively strong and probably one of my favorite growth businesses in the entire market right now, even if we are trading at about $2,300 per share. Keeping in mind their easy numbers, revenue was up 39% year over year. In terms of their e-commerce brands, items sold 39% year over year. Fintech monthly active users up 28% year over year to 72 million customers. And operating income up 30% year over year. Their margins were a little bit down because of those one-time expenses, tax events as well, and impacts of foreign currency exchanges. But still, the business is growing. All of its lines extremely solid, guys. The e-commerce growth of this business and the fintech growth of this business, the two major arms of this company, are insane. Let me show you some quarterly KPIs. Marketplace highlights, unique active buyers, 26% year over year, excessively strong, and it keeps getting better and better every single quarter. This is for their e-commerce side of the business, the Amazon side of their business, essentially, right? Marketplace highlights in terms of gross merchandise volume. Take a look here across all your different segments. Argentina, 44, Brazil, 34, Mexico, 34, other 30, and consolidated whole business, 35. Argentina has been coming down because they really started growing into that market about 2-3 years ago. But still, if you can slow down from 200 to 75 and still be at 44 in line with the rest of your markets, that's very solid growth, guys. Items sold year over year. Look at all this, man. Crazy, crazy, crazy. Consolidated number, 39%, as we previously said. Same day and next day shipments, kind of like Amazon right here, 173 million, which is absolutely massive, up 28% year over year. This company's logistics keeps getting better and better, right? A lot of their products are now same day or next day delivery, which is not an easy thing to do. 52% of their shipments are same or next day. If you guys know the infrastructure in South America, it is not like a lot of other Western companies, our countries. A lot of this last day, a last mile delivery, right, are done on motorbikes. Sometimes the infrastructure, the roads are not too good. For them to be able to do 52% same day, next day for all their clients, where a lot of Latin America is rural, that's very, very impressive for this company. It just shows their operational excellency right there. Marketplace highlights more items sold per unique buyer. People that are using the platform, are they using it more and more? Yeah, 8.3 up from 7.8. Very, very strong, 11% increase year over year. And that's just e-commerce numbers, right? Now let's move into some of the fintech services numbers. Fintech monthly active users, strong, 29% growth year over year. Excessively strong here. Growth across Brazil, Mexico, and Chile as the value proposition continues to improve. Assets under management, very strong, 15 billion at this current stage right now, up 89% year over year. That's absolutely massive, guys, right? Credit portfolio, whether it's consumer, credit card, merchant, or asset backed, everything continuing to grow, especially the largest two cohorts, consumer and credit card, but they do offer merchant payment solutions as well. Moving on further here, net interest margin after losses, 21%. That is insane net interest margins for this company. Moving on further, past dues. This is a problem that sometimes you see in Latin America for various companies, whether it's Nubank. You guys know ticker symbol NU. We talk about these delinquency rates a lot. They are higher than the West, of course, but is the company growing net interest margins faster than it's losing on its delinquencies? The answer is yes. That's why the business is still strong. Do not expect to see the same delinquency rates as in a country like the US, Canada, or several European countries as well. That being said, not too bad. 15 to 90 days past due, 6.8, 90 days past due, 17.6, getting marginally better. And then we have provision coverage, right? In the event that these people do run into a default situation, the 90 days past due, has the company put away enough capital to kind of service those defaults? The answer is yes. 90-day past dues, they're capitalized 150% strong. And 15 days past due, they have enough money for all of those guys as well. Strong business, making more net interest margins from the people that do pay than the people that are unfortunately delinquent right now, and acquiring total payment volume right now. Look at this, guys. It's insane, right? 32% year over year in acquiring total payment volume. PayPal would love these growth rates. This is a fast-growing fintech company in Latin America overall. Monthly active sellers with credit, showing that the company is able to better cross-sell their products, right? From, if you come to e-commerce, they'll offer you some credit solutions or other solutions as well. So very good execution in terms of cross-selling across different segments, guys. And the last, we can look ahead, right? Management's discussion about looking ahead. We believe we are still in the early stages of realizing our full potential, with e-commerce penetration of just mid-teens in Latin America and single-digit market shares, in some cases, low single digits in many of our fintech businesses and advertising. Yes, even with those monstrous numbers, their penetration is still in the early stages for both of their businesses, e-commerce and fintech. This conviction drives our approach to investments aimed at continuing to improve our value proposition for individuals and merchants in commerce and fintech. While these investments put short-term pressure on our margins, other investments, such as the credit card in Brazil, begin to mature and their margin pressures ease. The balance between new and maturing investments will vary over time, but the common theme across all of them is their long-term nature and our conviction that they will drive sustainable engagement, growth, and scale. We are confident in our ability to execute on these growth opportunities, and we remain committed to doing so in a disciplined manner. The management of this business is one of the highlights of this business, guys. They're not careless with their money. They are very calculated in how they choose to spend money and which segments of the business they choose to grow and when, right? Or when and why. That being said, guys, Mercado Libre, a company with phenomenal growth ahead of it. And the company's only like, $118 billion market cap right now. And I'll show you why that matters a tremendous amount, right? Look at the EPS growth over the next 4 years. The company is literally coming in to its exponential growth in EPS. The company is coming in they've had great years so far. They're coming into the massive numbers soon. From this year to 2028, they're arguably going to 2x their revenue again. And in terms of the balance sheet right now, are they employing a whole bunch of debt to where it's unsustainable? Actually, no, right? They are using some debt, but look at the free cash flow per year and the debt and the amount of cash they run on the balance sheet. Extremely well-managed business for a very fast-growing company. Now, that being said, at $2,300, I kept saying back here it was a buy on the channel when we were taking a look at this a few weeks ago into earnings. And at $2,320, is it still a buy? Only 7-8% away from the lows? Matter of fact, yes, guys. Forward PE for 2026, you're trending at a 37. You might say, oh, that's a little bit high. Well, yeah, but they're growing EPS on average 42% for the next 3-4 years. It gives them a PEG ratio of 0.88. When I redid these numbers with 2028 and their forward guidance, I was amazed at how low the PEG ratio actually came down. Forward price to sales is 3.26. I'll remind you, Amazon is a 3, but Amazon is not growing at this ratio, of course. Free cash flow yield of 4% is really good for this business. And if we just take a straight line price to sales and give them a little bit of margin or multiple expansion here up to a standard 5, which should be good for these growth rates, right? At the top end of their valuation, you end up with a market cap by 2028 of $264 billion, which is well above a 2x from now. Not bad for a compound annual growth rate for this business. It is relatively cheap. There is some very nice possibilities for some expansion. And as long as they continue executing the way they have been in the past few years, they should be able to get it done. So is Mercado Libre a buy here? In my opinion, yes. And I have been buying more shares during this entire consolidation period. I was buying here, I bought down here, and I will be adding a couple more until it becomes an unfavorable value versus the compound annual growth rates that we can get by 2028. And so far, right? Where I would probably draw the line is, maybe if we come up to like 28, 29, 3,000, that's where I might stop my DCAs. But down here, I'm definitely participating. That's everything for Mercado Libre. Hopefully you guys enjoyed that. Two more that are left right now. We're going to get into one of the problem children of this market recently. We're going to do Chipotle right now. So Chipotle, obviously coming down 15% after earnings, or 18%, recovering a little bit, but really nothing much to show for it, right? So Chipotle, a company that was loved by the general population and by investors alike from their expansion after COVID all the way through last year before peaking and now down 55%. You might look at this chart and think, ooh, Chipotle is a great deal right now. Well, there are certain little red flags to this business, and it may not be a suitable investment for everybody. Maybe a nice trade with a longer term time horizon. The long-term portfolio, you have to ask yourself a few questions. Let's get into some of the numbers real quick for good old Chipotle. So Chipotle, what happened? Well, I'll show you what happened. They beat on EPS by a hair, 1.5%. They missed on revenue by 0.46%. But it was the guidance, guys. The guidance was not very good at all. Revenue was up 7% year over year, but the problem with that, it came from more stores and higher tickets, not because people were going more to Chipotle. No. Only because they opened more stores and because they raised prices. That is not organic revenue growth. Average store sales, this is not comparable store sales. On average, how much money is every store bringing in, right? Minus 2%. I'll show you the comp store sales. Store level margin was down 100 basis points. Operating margin fluttering a little bit. And operating income only up 1% year over year. Take a look at more statistics right here. Comparable restaurant sales increased 0.3%. That's not very good. I'll show you why. The total increase in revenue was driven by new restaurant openings, and the 0.3% in comp sales was due to a 1.1% increase in average check, which is partially offset by lower transactions. So the ticket price is higher because they're raising prices. They opened more stores, but lower transactions of 0.8%, that's not too good. Now, they did have a good sales mix here. 36%, 36.7% of total food and beverage revenue was from digital sales. Not too bad. Operating margins was down 15.9 versus the 16.9 as well. Now, in terms of other things from Chipotle, guys, this is what killed the stock. This is what management said on the earnings call. Earlier this year, as consumer sentiment declined sharply, we saw a broad-based pullback in frequency across all income cohorts. Since then, the gap has widened, with low to middle income guests further reducing frequency. We believe that this guest with a household income below $100,000 per year represents about 40% of our total sales, and based on our data, is dining out less often due to concerns about the economy and inflation. They are losing customers, not to competition, they're losing customers to cooking at home. A particularly challenged cohort is the 25 to 35-year-old age group. Why? This is not good. We believe that this trend is not unique to Chipotle and is occurring across all restaurants as well as many discretionary categories. Where have we heard this before? Coca-Cola, Pepsi, McDonald's, Walmart's told us about this. So many other consumer discretionary stocks have told us exactly about this. Discretionary spend has been a problem for a year right now, and it's not getting better. The group is facing several headwinds, including unemployment, increased student loan repayment, and slower real wage growth. We tend to skew younger and slightly over-index this group relative to the broader restaurant industry. Not very good comments, and they did not say it was going to get better anytime soon. Matter of fact, their guidance was not very good at all. In terms of the forward guidance here, guys, full year comparable restaurant sales to decline in the low single-digit range. That's what they said is going to happen towards the end of the year. So is the pain on Chipotle over? I wouldn't think so, guys. Maybe short-term pain on the stock price because we've gotten absolutely crushed right here. But are they going to return to the growth rates that they had just last year in the boom of quick service restaurants? At least for them? No, but it's not only Chipotle, man. It's Cava, which reports earnings this week. It's McDonald's. McDonald's is a high-quality company. They have insane margins, and a lot of that brand is obviously, big supply chain integrations, scale, economies of scale, and the fact that it's somewhat of a real estate business as well. So McDonald's, you can arguably not put in the same category, right? But Cava, the sit-down restaurants like Texas Roadhouse, not doing too good since late 2024, have they? Now, other companies like Cheesecake Factory, right? They tried to push, but still doing a whole lot of nothing. This stock hasn't moved in like 5 years. You know what I mean? And there's so many other quick service restaurant brands that we can talk about. Sweet Greens. What happened there? Crazy boom on all these companies, 2024. What happened, man? What happened? The higher end demographics for, Sprouts Farmers Market, things of that nature, high end grocery stores. What happened there since June 2025, right? These concerns for the consumer have started to be magnified in the most recent few quarters here. And Chipotle is just your more recent example of that. Now, investment in Chipotle, guys, right? You also have to keep in mind the consumer perception. If you go on Instagram, Reddit, Twitter, whatever your favorite social media area is, right? You'll notice these three common themes. Lower food quality, that may not be true, but that's the perception. Perception matters a lot when you are a trendy brand. Higher prices, right? Now, a lot of, they did a statistical analysis on this. I was looking at a few analysts saying, listen, the price of an average Chipotle bowl, if you don't take the extra guacamole, is closer to $10 than it is to $15, but people perceive it to be still $15 in relation to other quick service restaurants brands. Perception, consumer perception, guys, for consumer brands, whether it's Nike, Decker's Outdoor Brands, Lululemon, all either fashion brands or quick service restaurant brands, right? The perception matters arguably a lot more than what's actually happening. I know it doesn't make sense, but at the end of the day, it does, right? Because this is like, you're betting on, this is like social arbitrage, more so than fundamental arbitrage here. And uneven portions. This has been a talking point for the last literally 2 years. Brian Nichols, before his departure, tried to fix this. The new CEO, I don't know what he's been doing, but hasn't been bringing it up that much. Brian Nichols used to care a lot about this, but then now he's at Starbucks, right? Trying to fix that company. So is Chipotle an investable company right now? Fundamentally speaking, well, let's have a look. Forward price to earnings at $32 for 2026 is a 26 forward price to earnings. Not terrible. They're trading at a 1.59 peg, growing EPS at 16.4% per year and revenue at 11.5% per year through 2028. Maybe if things don't get better, we will have to revise this number down and this number down as well if they run out of pricing power, right? It's always a supply and demand function, right? If you cannot raise pricing anymore, aka you run out of pricing power, well then forget expansion on EPS growth if you're not going to be able to raise your revenues, right? And same store sales. It's just how it works. They'll still be opening new restaurants. They plan to open, between 315 and 345 restaurants this year, but still that's not organic revenue growth, right? You can open as many restaurants as you want, but if they're all empty, then it's not going to be something, right? And you guys know, back here out of 2018, 19, and COVID through the last few years, when I used to go to Chipotle, it used to be full. There used to be lineups. Every single time I've been into a Chipotle recently, over the past, I would say 6, 9, 12 months, it's been empty, man. There's just no other way around it, right? So once again, perception as well, right? So that being said, they traded a 1.59 peg. It's still not cheap. With this much decline, it just goes to show how rich Chipotle was trading. You would expect it to have a 1 peg and an under 20s multiple. It's not. Arguably, this company is no cheaper than Google. How is that possible? You know what I mean? And you're talking about Google here. Would you rather invest in Google? Peg ratio allows us to compare apples to oranges, different companies across different industries, right? In terms of what are you paying for the growth? Am I going to pay 426 and a 1.6 peg for Chipotle, or am I going to pay that for Meta or Google? You know what I mean? Or Amazon, Amazon's literally this. Amazon is high PEs, but a 1.6 peg, right? It's what am I doing here buying Chipotle? I mean, the price to sales is 3.19. Closest comp you have is McDonald's. But once I said, even comparing to McDonald's is apples to oranges, guys. McDonald's is a well-known international brand. It's the quick service restaurant brand with the second most amount of restaurants worldwide. The first being Domino's, because they can have all these tiny locations all across the world. KFC has a tremendous amount as well internationally. But still, right? Chipotle is not an international brand. They haven't tried to expand an international concept. And I'm not talking about some restaurants in Canada and a few handful of restaurants in Mexico, right? No, I'm talking about Europe. I'm talking about Asia. Can they expand the concept? Not sure. So you can't really compare it to McDonald's or Domino's for that measure, right? That being said, that's what I mean when I say, is this company a short-term trade or is it a long-term investment? This is a company that I would never put in my long-term portfolio. There's only 2 food companies I would ever put in my long-term portfolio because of the resilience of the business model and the margins. I mean, number one would be McDonald's. It's not the sexiest company. It doesn't grow the fastest, but you're sure of what you get with McDonald's, right? They have decent pricing power. They have so many promotional schemes. They have such a wide supply chain. They have so much in terms of net margins here. It's not even close, right? So McDonald's is like the only fast food company that I would ever consider putting in my long-term portfolio. Chipotle, is it a fad? Is it ever going to be as good as it was before? Are they going to be able to expand it internationally into something like a McDonald's, something like a Starbucks? Will they have unlimited pricing power forever? Are people just done with the whole Mexican quick service restaurant trend? There's so many questions to put in a long-term portfolio and say, okay, I'm buying Chipotle now. I'm going to sit on it for 10, 15 years. I don't know, man. At these prices, there's better companies with wider moats, wider competitive advantages, much more international exposure, and you do not even have to look further than some of the big tech names, right? So it's a tough long-term position. If you want to go for a swing trade here, the only thing that makes sense on Chipotle is if I say, listen, it's crushed, it's in a support, it's at 2020, 2022 prices, right? The valuation is not terrible anymore. We're arguably so oversold on the weekly, oversold on the daily, like it's 18 RSI, is now a decent position for me to throw a couple $100,000 as part of like a high six-figure portfolio and just say, whatever, I'll just throw some money at Chipotle, whatever happens, happens. Yeah, but it's that type of trade for me, right? It's not a, oh my God, the business is doing so well. They have such a good concept. They're expanding internationally everywhere. Wall Street is clearly wrong. That's not the type of thing that we can say. There was a few companies this year that we could say, Wall Street is clearly wrong. The stock hasn't been moving and it should. This is not one of those companies, right? It's not a lottery trade, but it's another recovery story trade, right? You can say the same thing about Nike, say the same thing about Lululemon. I could show you guys 15, 20, 25 different companies that have this same problem, right? Consumer discretionary is weak. It's an execution problem at the same time as well, running out of pricing power. You're not too sure. You're counting on the big recovery of the big economy and consumers just coming roaring back to Chipotle. That's a big ask, you know what I mean? I'd rather play companies that have a more favorable narrative, but that's just me. Down here, $30 to about $25 remains your big support area for you to possibly play if you're willing to take that risk on the stock. And that's all my thoughts on Chipotle. Hopefully you enjoyed. And now last but not least, let's take a look at another one that just completely got erased this year, right? From the top in May to where we are right now, Fiserv down 72.5%. One of your worst performers in the S&P, monthly oversold. When's the last time it got monthly oversold? Oh, never. When's the last time it got this deep oversold on the weekly? 14 RSI. Scroll back. Oh, never. Not even in 2008, right? So is Fiserv a screaming buy right now? Or has the market justified the sell-off? Let's take a look. Moving on to their EPS. EPS crushed. 23% miss on EPS. 8% miss on revenue. And the guidance was a disaster. Management pulled guidance. They were supposed to come in at 8.5%, 9% revenue growth for this quarter. You guys want to take a guess how much they actually did? Yeah, it's not too good, guys. Taking a look right here, Fiserv, revenue 1% year over year. The guidance was for 9, 10, 8.5 to 10, 1%. Miss on EPS, down 11% year over year. Organic revenue growth, 1%. That's down 86% year over year because they're supposed to come in at 9.5 or 8.5 to 10, right? Share repurchases, still $1 billion. But you know what the problem with Fiserv is with all of these buybacks? A lot of people talk about the buybacks of this company. People don't understand that the previous management, the previous CEO to be specific, right? He leveraged debt to get these buybacks done. Look at the amount of debt the company's running, right? This was all or mostly put to buybacks, not so much investing in the business. And that's a problem. The company dropped 40% after earnings because of misrepresentation that the former CEO had done. And now the new management has to fix it. Look at all this debt. You're talking about a $35 billion company, right? That brings in per year about $20 billion of revenue, $3 billion of net income. They have $25.5 billion worth of debt. That's not a very attractive capital position, especially when you're using most of this capital to buy back shares all the way up here, right? Just not the best use of capital in my humble opinion. But let's analyze what happened to Fiserv overall, right? Because it can't just be the numbers. I mean, the earnings were bad or whatnot, but why did it drop 40%? And why does it keep going down? One of the big reasons, guys, right? Oh, if you don't know what Fiserv does, by the way, but they have two arms of their business, right? One is a point of sale terminal, which is their Clover terminals. If you guys know what I'm talking about, Clover POS terminal, it's this one. You guys have probably seen this in stores, restaurants, things like that, right? These little Clover terminals right there, it's called point of sale. Tons of different companies have this, right? Square has their own type of thing, right? So these are the point of sale terminals. So they have that. They call that the Merchant Solutions division of the business. That's the division where growth has been flat for the past 5 quarters. It's been the numbers have been artificially inflated by the previous CEO, unfortunately for the business. And we found that out this quarter. This quarter was just a whole bunch of people are wondering why is the stock dropping so much? Now we understand why. It's because there was some misrepresentation of the company, and there's a lot of lawsuits against Fiserv right now. But then the core portion of their business, this is arguably the best portion of their business. This is what they call their actual transactional, or rather they call it financial services portion of the business, right? To where they're the middleman. They enable processing between merchants, financial clients, and the payment networks such as MasterCard, Visa, Accel, Zelle, and other networks, right? So they kind of match the banks with the end payment solutions. They collect a little bit of a fee, when you tap your card or whatnot, things of that nature, right? They collect these transaction and processing fees. This part of their business is a very good portion of their business. If I had to invest in one of these 2 portions, I would invest in the bottom one, financial services, hands down. Point of sale is extremely competitive, guys, an extremely competitive landscape. And I mean, you've been able to tell, right? In the past few years, fintech just has not been doing good at all. It's a very, very competitive landscape. And, these guys make money on volumes, right? And if consumer discretionary spending is soft or softer than in 2021, for the past 3 years, you have impossible comparable numbers to 2021 volumes in terms of payment processing. That's why PayPal has been soft. That's why Square has been soft. That's why this company's been soft. Well, I mean, until they were artificially inflating their numbers, and now we're back to reality, right? But so many other fintech players have been soft since 2021, and it's because of the whole consumer narrative behind it, right? It detracts from overall volumes. Now, here's the thing. If you guys didn't know, right, a lot of people just looked at the numbers and said, how can they be down 40? It's because you guys are missing what happened, right? So I'll read it to you, and you really had to look for this, right? Because we just found this stuff off this quarter. Even me, last quarter, I was saying, Fiserv is not that bad of a buy, right? It's kind of like an SMCI situation. When you believe their numbers, it was not a bad buy. I closed. You might remember I had some positions here. I closed them because it was dead money for the entire quarter. And I was like, no, I'm going to wait to see what their next quarterly earnings is. If they can turn around, right, their growth metrics, maybe I'll be interested. I was waiting for this quarter to reposition because it was attractively valued. Now there's no way I'm touching this company. I'll tell you guys why. They have a lot of work to do, okay? The new CEO, Mike Lyons, who took over from this guy right here. You can't see his picture. Sorry. Frank Bisignano, okay? The former CEO who now works for the Trump administration, by the way. The new CEO who took over from Frank in May delivered before analysts and investors a brutal takedown of the Milwaukee-based company's failings under the leadership of the man now in charge of Social Security for the Trump administration. Frank Bisignano was the CEO of Fiserv for 5 years, from 2020 to this year, and chairman as well for the past 3. Sales forecasts made in recent years would have been objectively difficult to achieve, even with the right investment and strong execution. That's what the new CEO literally said right now on this earnings call. The forecasts made by prior management would have been objectively difficult to achieve, even with the right investments and strong execution, which they did not have, by the way. Under Frank Bisignano, the company made forecasts it could not have plausibly have achieved. Management made decisions to defer certain investments and cut certain costs, which improved margins. They were embellishing the income statement and the balance sheet in the short term, but are now limiting our ability to serve clients in a world-class way, execute product launches to our standards, and grow revenue to our full potential. That's not very good, guys. That's big misrepresentation for the past 4 or 5 years. It's really not good. The former CEO relied on short-term cost cutting to the detriment of the company's long-term health to show better and better numbers, to increase his bonuses, get a whole bunch of stock comp. And by the way, he sold all of his shares. In recent years, quarterly earnings increasingly relied on short-term initiatives. Those initiatives, the new CEO said, placed too much emphasis on pursuing in-quarter results for stock comp, as opposed to building long-term relationships by prioritizing business that both meets our clients' needs and comes with high recurring revenue. So the former CEO is chasing short-term quarterly results, not building the business. And he sold everything. He didn't just get out of Fiserv before the collapse. He sold all of his stock before the price plunged, and he was able to use a government loophole that allowed him to avoid capital gains tax on those stock sales, potentially forever. That is why this company plummeted so much. misrepresentation and red flag accounting, guys. That is not the type of this is going to take a while to solve, right? If you're looking for a quick earnings recovery, no shot. This is going to be a multi-quarter, dare I say, multi-year recovery story. I'm not the biggest fan. You can say it's trading incredibly cheap. This is true, but how many things do they have to do to turn around the business and to turn around investor sentiment and also institutional investment? Because a lot of institutions, they just cut their positions and just stop giving guidance they pulled their ratings from the business, of course, right? It's a very, very bad thing for a company when that happens. Third quarter year-to-date results, we'll look at the numbers overall, right? So this is what I don't like about this company as well, right? They focus a lot on year-to-date gains, but look at your adjusted revenue over the quarter, right? Or year over year, yeah? They show year-to-date, okay? Year-to-date, just to show you that it's not so bad. But year-over-year comps, 1% in adjusted revenue. Declines year-over-year, 3.2% in operating margins. That's not good, but they'll show you year to date, it's not so bad, right? Because, they started from here and now they're kind of right there. Adjusted EPS down 11% year over year, but year to date, right? It's not so bad. We've added some EPS in aggregate, right? Okay, Merchant Solutions, they did the same thing here. And I can't blame them because, it was a disaster. So they got to try to show some sort of growth, right? Look at adjusted revenue, right? If you were to take year over year, which every company reports year over year, I've rarely ever seen year to date. They'll include it after year over year, but they'll never not show year over year. Where's my year over year comparisons here? I don't know, but I had to do the math for you. So small business, enterprise processing down 3, total 7%, organic revenue 7% year to date. But what are the year over year comps, guys? Merchant Solutions were up 4.7, Financial Solutions down 3.3. These are your true year over year revenues, right? Now, the revenue was flat over year for Clover Solutions, which I'll show you down here. Clover has been flat now for 4 quarters. 4 quarters it's been flat. This is supposed to be a big growth driver for their business. No formal guidance on when that is going to improve. Not good enough. Financial Solutions right here. You have a year-over-year decline, right? But then they represent year-to-date growth because it's true. They're stacking more money on year-to-date basis, right? But year-over-year, you want to see growth. It does not have growth, right? Digital payments 3, issuing 8, and banking down -2. Not very good at all, but they will highlight their 19% growth in Zelle transactions, right? That is not bad. A large healthcare deal, 2 major government contract wins, Treasury Department Express debit cards through the Money Network, and the FedNow disbursements for FEMA. Okay, talking a little about Argentina right there, and now capital expenditures, decent amount of CapEx, high amounts of free cash flow, got to give them that, but share repurchases, they do, with their free cash flow, man, they do a lot of share buybacks, right? But when are you guys, for declining revenue growth numbers, when are you guys going to pay back this $30 billion in debt? When? Because it's getting very close to your market cap, which is arguably, it's coming to be negative debt to equity ratios, right? That's not very good for the business overall. So as we can see, yes, the company generates good amounts of free cash flow, but you had huge accounting and financial misrepresentation, years and years of mismanagement, not investing in the business, only showing what shareholders wanted to see, and now it's finally caught up for them. So is it the recovery a question of days, weeks, months? No, probably quarters and quarters and possibly years at this point in time. Now, Fiserv, good thing for them, they do have a very strong back end, right, for their financial services. Merchant Solutions, very competitive. I wouldn't count on it. But Financial Solutions has been relatively good for them, right? That is where their biggest competitive advantage is right now. So would I invest in this business for the long term? Oof, man. If I bought this stock here at a crushed valuation at 67, it's trading for the problem is you can't, it's just like SMCI, right? You can't believe these EPS growth numbers. And what are the revenue growth numbers going to be? Well, analysts have penciled in some things for the next few years, but it's going to be a quarter by quarter thing, kind of like UNH, right? You want to trust these forward estimates, but it's so cloudy right now that you can't give them that much credence. So that's the problem here. So you can say it's trading a forward 7 price to earnings, a 0.5 peg, a very cheap price to sales, and an incredible free cash flow yield. But then again, guys, right? How much credence can you actually give the forward growth estimates for this business? So that being said, they got a lot of debt on the balance sheet. It's completely oversold. It's crushed. Valuations, technicals are completely crushed. This is just like Chipotle, right? if I wanted to throw a couple $1,000 into the stock or in some leap call options for deep 2027, December 2027, and say, you know what, I'll throw a couple $1,000 at this one, we'll see what sticks. Sure. Would I be investing in this business for my long-term portfolio, saying this is one of the best companies in the entire market, I absolutely need to have it in my long-term portfolio because eventually it's going to be a, $100, $200 billion company? No, right? Very competitive landscape in fintech overall. Not my favorite fintech player, that being said. So this one again is the example of a company that could be good for a swing trade, but only with an amount of money that you're willing to park there for a very long time, like we said on UNH after the big collapse, or very, 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 long dated call options. And you just kind of take your chances and you say, listen, maybe it's bad, but maybe it's an overreaction. It's super cheap and you just go for it, right? But I would not be holding long-term shares of this thinking that, it's a great position to have in a long-term portfolio because I'm buying a very attractive, business with a long-term competitive advantages and high moats, like the two ones that we described in the earlier portion of the video, like Booking.com or Mercado Libre or some of the big tech names or other companies that we talk about on the channel all the time. Visa and MasterCard, man, I don't know what you guys want me to say. They're my favorite payment networks. Visa and MasterCard are my favorite plays in the whole financials or fintech space, anything related to payments. Visa and MasterCard are the only two companies that I have in my long-term portfolio for the whole payment space. So take that one as you will. That being said, that's everything I had for you guys today. Now let's jump into some technicals for the charts. I'm going to start it off, of course, as we always do, with the good old S&P 500. So the video is already an hour and 20 minutes long, guys, just with that big analysis up front and then the earnings play. So forgive me, I will just have to fly through the charts at this point, just giving you guys levels to kind of play off of, right? So the S&P bull is still in full control right now, daily uptrend. Now your line in the sand is down here, daily higher lows 663.50, and your support level, first one at least, is 675 and about 670. That being said, the bulls still control the weekly time frames, but we went over all the bearish catalysts potentially, right? We understand that as well. We are very close to the top end of our trend line. We are very extended from the weekly 12. We are just pending some any news that could send us into a correction. If it does happen, do not be surprised. But until it does happen, the bulls are in full control. But we went over positioning, right, in terms of being careful. Moving on to QQQs right now. Still a tech-dominated landscape with good tech earnings overall. Left back a couple gaps, which might be filled over the course of the next week if we get some negative macro or just negative sentiment in the markets. Line in the sand is 600 for the daily uptrend to continue. If you unwind this, though, either by flushing this level one shot or the two-step drawdown, first support level right there, 611 down to 607, and the weekly bulls are still in control of this beautiful weekly uptrend, but we are very extended, guys, on the 12 from the weekly. Big extension right here. We are also very extended in terms of the monthly 12 as well. The bulls on these monthly candle closes, if you just look at these monthly candle closes, you would think that nothing is wrong. But when you look under the hood, guys, right, the breadth is a big issue. Moving on to financials right now. Financials also not performing too well over the course of the past, 2 months? Just kind of straight down despite good bank earnings, good credit card earnings. People are just not picking them up, right? And insurance plays are down, financial data plays are down. That being said, how do we stand right now? Well, the daily bulls forfeited the uptrend, rejection from resistance, which is 53.31, 52.88. Now we're in a big support, right? Monthly support level. So keep in mind, this big monthly resistance, nice support coming down to the 12. We will be looking for a monthly higher low for further trend continuation. But so far, still the weakness, right? Market breadth, or rather MACD on the financial sector, not looking too good. If we start off red in the month of November, you might just be looking into a little bit of a monthly leg of consolidation. I still like financials, not every financials play, but we've been very clear last week which ones I'm targeting. Visa, MasterCard, some of the banks, the big banks, JP Morgan, Goldman Sachs, and some of the financial data players like SPGI, Moody's Corporation, the ones that have very strong balance sheets, very strong business models. Moving on to XLV Healthcare right now, still rejecting from resistance, 148 down to 145. The weekly doesn't look too bad, but we did have a pretty significant rejection, right? So the line in the sand is 141. You lose that either one shot or two-step daily downtrend, rejection from resistance again, you'll be heading into more weekly consolidation. And if you flush this, sadly, that's it for your monthly run, and you might just be looking for a bit of monthly consolidation. Retracement size, very attractive. They will be looking to set up a higher low for possible expansion, but you're going to need better participation from healthcare overall. We're missing the health insurance segment, which is really weighing down this index. Pharmaceuticals have been a mixed bag. Medical devices have been strong, but still you cannot say that by large and by far the whole sector has been good, but it still is very undervalued in relation to the S&P. Moving on to our SMH right now, big bull trend. This is your index leading bull right now. So pay attention, guys. If you start seeing some declines on some of your best players in semiconductors, that's when the sell-off could possibly happen. When your lead bull turns lead bear, that's when you usually find a bit bigger consolidations in this index. Line in the sand, 333, nice daily uptrend, pay attention. If you come back down, you might be testing these guys, 346. If you unwind in one clean shot or two shots, right, you're looking for weekly consolidation. We are extended from the 12, we are overbought conditions, everything looks ripe for some consolidation, but it hasn't happened yet. The bulls haven't told you that they're too tired by forfeiting these daily uptrends. So hedging is fine, but predicting a massive market crash when you control the weeklies like this, somewhat unlikely. The monthly time frame's a big extension from the 12, guys. And semiconductors does this, right? But eventually they do have some pullback phases. So we have to be cautious of these pullback phases. I'll be a big buyer. Monthly overbought, monthly is stretched, weekly is stretched, daily arguably is stretched as well. If we see some pullbacks, I'll be shopping for my favorite semiconductor names, NVIDIA, AMD, possibly Micron, ASML, companies of that nature, right? Maybe not so much the analog plays like Texas Instruments or, other things of that nature. Moving on further to the Russell. The Russell down, line in the sand, 241.19. Daily uptrend, yes. Looking to protect it and expand, yes. But if you unwind below this, well, that's it, right? That's it for your daily uptrend. And you might just be heading into a bit of weekly consolidation. Line in the sand is down here, 238. If you lose that, you lose the weekly uptrend, and you just head into monthly consolidation, which you've been talking about for a while, looking for a pullback on the monthly into 231 down to about 225. Monthly 12 EMA, previous resistance should be support. So pay attention to it. If you get some index drawdowns, the Russell will follow. Moving on further to consumer staples, one of the weakest segments of the market, testing the January and tariff lows. That being said, nice support range right here, the highs of 21 and 22. Down below here is huge support, bear market support, as a matter of fact, 73. Is it a good segment to position in? Because if growth takes a bath, right, this one is maybe almost done, right? Is it a good sector to balance some growth names in? Yes, it's not for everybody. They're not the sexiest plays, but it makes sense to have a bit of value exposure down here now that they've been crushed to some of our 52-week lows into prior years worth of support, kind of like healthcare, right? It's worth the idea of a position, not a massive position, but it is worth a bit of a position right now because we are very close to daily oversold conditions. So selling some puts on this one or just accumulating some swing trade positions here for a possible further market drawdown, and then value might just, stand the test of time better than growth. Not a terrible proposition. Utilities right now, utilities consolidating, beautiful weekly uptrend on utilities, pulling back to the 12 possibly. We'll see if they actually respect it or go a bit lower. Weekly, a lot of space, 82.50 on the weekly is your spot. Daily, they lost a daily uptrend. So now you are into weekly consolidation officially. Utilities, decent segment of the market, guys. Monthly is not looking too bad, just maybe looking for some monthly consolidation. And we've been very clear which utilities plays we should be going for. The ones that have the most direct exposure to some of the data center plays because of their infrastructure right now. Talking about VST, if they pull back here after earnings, I'm a big fan. Next Era Energy, if we give back this entire move, I'm a big fan. Consolidation to years worth of support. Companies like Duke Energy, companies like Emerson, these are all some of the biggest players in the game that have the most direct exposure to data centers for the next few years. Maybe not for some swing trades over the next 2 weeks, but getting some exposure for the next few years, not that bad. The data centers need the power. There's not enough power to go around right now. Real estate, soft. Why? Because we're unpricing a lot of the Federal Reserve estimates for a December rate cut, in terms of another 0.25. Maybe they will, maybe they won't. I'm pretty sure they will, but real estate is just not having it right now, right? 41 down to about 39, not the best, but it is a year worth of support overall. So the real estate sector is broken down into different parts, right? The home builders, which are coming into the breakout retest zone, not bad if your thesis is no recession and expansion of the consumer into 26, 27, 28. It makes sense to try a bit of a position right here. Mortgage companies, same concept. Rocket Mortgage pulling back after good earnings. It makes sense to position if your thesis is for no recession and expansion of the consumer, right? So mortgage companies, real estate companies, by large, by far, not the worst, but it's going to be a bumpy trade because you have a clash of narratives right now. The rate cuts are good, yes, but the consumer is not there. So you kind of have that, right? That's it for our analysis on the index rundown and the rotation. We talked a lot about it earlier on in the video when we did the big intro, right? The VIX coming up a little bit. We'll see, right? Any further concerns and any rapid market declines will bring the VIX higher. You guys know when the VIX is high, it's time to buy. How do I choose to buy? I choose to sell puts on my favorite companies, high quality, high conviction companies that come down into support, to sell some put options down there. As of right now, the VIX is still low. So we'll see what happens. Yields still just doing a whole lot of nothing. The longer term trend is clear, 10-year weekly downtrend, and the 20-year yields weekly downtrend as well. That being said, with the recent uncertainty surrounding the December cut, which Jerome Powell kind of threw cold water on, well, that's why yields have been going in a bit of an upswing and why the longer term bonds have been pulling back a little bit too. If we accumulated some bonds up here, I will remind you, this was take profit 1 area. Take profit number 2 might just be met later in 2026. Or if there's some big uncertainty in the markets and the markets start selling off, people probably will come to bonds for a little bit of safety exposure. So that might help boost the TLT trade. Moving on to gold right now. Gold just kind of doing a whole lot of nothing, right? On the Friday session, down about 0.5%. Daily downtrend. The bulls are trying to get the daily bounce. As of right now, not the worst daily bounce, right? It's about a 618 bounce. We'll see what happens though, right? The short-term time frames, very, very confusing. You know, the bulls, they try to get the hourly back. They lose it. There's big institutional positioning, big central bank positioning. The cleanest time frame of them all is, you know, you're in a daily downtrend, looking for a lower high into further consolidation, because the weekly is also in some consolidation too. The closest price target here is 38.21. I may be exploring some trades, but I need gold to cool down. I need to kind of go into some form of a shorter duration accumulation range, maybe just slow down the volatility on the daily a little bit, give me an established tradable bottom range, and maybe I'll be interested in maybe a positioning for a gold leg higher. I don't think the central bank positioning will stop, but the monthly candle closes clear as day, right? We may have to get a bit of a pullback before going on for that future leg, because the monthly time frame's still very overbought on the RSI. Moving on to crypto right now. So crypto also, last week close was very soft, right? Friday had a bit of an upswing day. Today, Saturday, a bit of an upswing day. But where are we? In the middle of nowhere, right? Daily uptrend, completely unwound. Weekly, trapped between a range. The range is very clear. 115, 120 into the downside, 107 down to 99. That being said, clearest time frame for me is the monthly here, guys, right? Consolidation, expansion, consolidation, expansion, consolidation towards the 12. Maybe expansion if the SPY and QQQ give us a big short-term correction because of breadth concerns, consumer concerns, credit concerns, all of the above, or whatever it may be, right? You will probably come back into the 12, which is why I am accumulating some Bitcoin in these lower levels for a swing trade long, but a longer duration swing trade long, the expansion of the next cycle overall for crypto, right? Ethereum, same concept, right? Daily timeframes, all over the place. The one thing you should kind of see though is we are reacting nicely from support. 4K down to 3,700. Context, weekly downtrend. Further context, monthly downswing. That being said, we are looking for the bulls to hold here, but if they don't, you're coming right back down here to 33 to about 2,800. That's the next big support area where you had a lot of price action down there, even from back over there. I can extend it, right? You can see 3K is a big level, right? So how should we be playing this one? Accumulation here is okay. If you're not going all in YOLO, if you're keeping some buying power for down there, you don't know if they're going to come down there. It'll be largely predicated on overall continuation of bullish expansion on the indexes and possibly, you know, bit of rekindling of the risk on trade. If we get more market breadth, it'll make people feel a bit better. The risk on sectors may react a little bit better as well. That's everything for your overall market rundown with the monthly candle closes. Now let's move into our big tech names. And unfortunately, I won't be able to cover today, guys. Biggest gainers and losers. We're already an hour 30 deep into this one. So I'll get through this big tech list and probably even the portfolio. I may not be able to cover. I may have to do it tomorrow on the top 5 options play or in the, what's it called? In the Monday video recap, right? But, you know, all things considered, we had a really good week. We had a good week on wheel trades. I wound down some of the unprofitable assignments. We got called away on 2 assignments. We wound down the Duolingo shares with a $1,000 position. We lost like not even $200, very tiny position. But I wound down anything that wasn't high conviction. Lottery trades, we had a nice NVIDIA win right there. And all of our earnings trades and other lottery trades made up for the one little tiny loss I took playing Chipotle earnings. So it was a good week for us, but we wound down a ton of capital. But, you know, maybe I'll show you more of that at the end of the video, depending on the time. But that being said, let's get into Apple and the rest. I'll try to do them in 10 minutes. Probably the fastest you guys will ever see me run through this list right here, because I will refer you to all of the earnings that we covered this week for like half of this list, right? So Apple right now, clear as day, right? Daily uptrend is very nice right now, yes, but we are very extended, right? Daily overbought conditions, Daily uptrend is nice. Line in the sand is down here, 255, in confluence with our previous resistance range, which should now be support. So the bulls have a lot of space here for any pullback. The earnings were good. That being said, the weekly candle, not the best close. Weekly uptrend, yes, in motion. Very tough to position up here. And I said as much after earnings, right? Valuation, tough to add any more shares up here because of the valuation, right? But they will be having a very good Q4 guidance. So I'm holding all my Apple shares. I'm not adding any more. I'm not selling any Apple positions, and all of my Apple swing trades accumulated here and lastly here would now be sold on the break of the all-time highs because we're a bit stretched in terms of the technicals and the fundamentals as well. So no swing trades on me for Apple and not adding to the long term. Moving on to AMD right now. AMD also very stretched. They have earnings on Tuesday, though, so tough to say. This company's going to move 7-8% off of earnings. If you ask me, I think they should have a good earnings release, right? But the stock has run a ridiculous amount since last quarter, mostly because of the OpenAI deal. The long-term thesis, very clear, though. Big expansion of EPS, big expansion of revenue as well. So short-term swing trades on AMD for me? No. This line in the sand is down here, 225. Daily uptrend is still clear as day. Resistance, 239 should be current support, but the earnings is going to move at 7-8%, right? 8% to the upside, you're looking at 275, 280, big expansion, even more overbought on the short-term timeframes. So AMD is only a position for me to add leap call options if I really want to go for it. I mean, the time to add was back here. We said it on the channel so many times, right? Leaps from here, maybe. It's very greedy, a very, very greedy trade, but my price targets for AMD into 2027, right, is like 350 bucks, 325, 350, but do we get a big pullback first that might offer you better entry? Yes. If we're buying any swing trades up here, we have to be willing to DCA on any consolidation, but the long-term fundamentals look good. Moving on to Amazon right now. Amazon had ridiculously good earnings, but they just were not able to keep most of it up during the course of the day because Friday was a very awkward day for price action. That being said, earnings, I will defer you to our video that we did last Thursday. Strong all across the board. Valuation, manageable. Would I be adding long-term shares here at 244? The answer is yes. Would I be adding longer duration swing trades? The answer is yes. But don't kid yourself. If the markets pull back because of breadth concerns, consumer concerns, whatever, Amazon's coming down to maybe where? Well, maybe back down to the previous all-time high range, right? Talking about the 235, 230 area. That'll be a nice location, bit of a breakout retest area. But so far, Amazon is looking strong. Daily uptrend in control. Weekly, nice engulfing move, but you still have to reconfirm the weekly uptrend. And the monthly, closing very strong as well, looking for monthly expansion. So if we consolidate into November, for some which reason, they gave us the guidance. The fundamentals show that we should be in this stock, but it's not going to be immune to any short-term price fluctuations of the overall market. So if I do find some dips, of course, I will be a buyer. And even for some longer-term positions, I am holding them. Moving on to Google right now. Google, solid earnings. We covered them on the channel just last week. Of course, daily uptrend, fully in bull control, but extended on the daily RSI. Very greedy longs up here, guys. It makes sense if you have a long-term time horizon, right? We did the valuation. It makes sense. The stock's cheap, but short-term options up here, or even leaps from up here, without overall market pullback on extensions, right? It's a very greedy trade. It can work. Greedy trades can always work, right? But it's very, very greedy. It's just not my style. Line in the sand is down here, 245 for a loss of the daily uptrend in one shot, or two-step daily downtrend would just mean weekly consolidation. Line in the sand is 237 for that weekly consolidation. Monthly close, solid, but very extended from the 12 EMA. When has Google ever been this extended from the 12? Well, it did it back in 2021. Then we went into a bear market, but never, whenever it gets up here, right? There's always something that happens. Either just with Google price action or the overall market, yeah? So Google, I'll be a fan of waiting for a broad market consolidation phase to maybe further position. If it just runs away from here, no problem at all. I have tons of Google shares that I spent all year accumulating pretty much when it was low, so I'll keep them, right? But short-term trades up here, very greedy in my opinion. Meta down 2.72%, more losses after earnings. That being said, the daily uptrend is clearly lost. This level up here turns into resistance. Talking about 706 down to about 680, which was the buy zone prior earnings. Now it's even better, right? So weekly downtrend is continuing at this current time. Monthly, you are in a monthly consolidation phase. Usually picking up Meta around the 12 is not a bad prop position. Every time they've come down here, it has been a nice buying opportunity, but you may not get the lift immediately. So it has to be an accumulation trade for some long-term shares. Next support is down here, 640. down to about, it's a very small one though, guys, 640 down to 620. The bigger one is all the way down here, 600 to 564. I'll be accumulating the entire way for longer term positions or leaps, right? Short-term swing trades on Meta, if you're looking for them to recover this immediately, it might just be wishful thinking, right? There was a lot of problems around the CapEx raise and the expense raise without them showing that they're making much money from this or that they're making many productivity gains, such as Microsoft, such as Amazon, such as, Google has been doing, right? Their cloud segments, Google, Amazon, Microsoft cloud segments have been pushing higher and higher and higher, right? Meta doesn't really have anything to really justify this amount, right? What we've said on the earnings calls from Amazon, Google, and Microsoft, they're demand constrained, right? So they have to do it. Meta is just trying to get ahead by spending this amount of money. It's a different context. So that's why Meta stock can be down here for maybe a while. I'm not saying it will. Maybe it just shoots up higher, and that's fine. I've positioned already, right? But if it stays down here, don't be surprised as to why. The valuation, though, is good, and we covered that after earnings. Moving on to Microsoft right now. Microsoft, we also covered after earnings. They've been doing nothing but come down despite posting very strong numbers. The valuation right now, Ford 33 price to earnings and a 1.9 peg. It is relatively high, but Microsoft has a extremely resilient business model and is a jack of all trades. Support is down here, 518 and about 501. Line in the sand is 507. You lose this, you lose your daily uptrend expansion, and you might just be heading into a loss of the weekly as well. The weekly higher lows are not that far away. If Microsoft unwinds this, you're just going into big, beautiful monthly consolidation, and I would be interested, very much interested, at the 12 because history tells us that when we're trying to buy in around the 12, it's usually a better proposition than buying all the way up here when we're very stretched on the technicals. Moving on to Netflix right now. Netflix up on the stock split news. It's coming right here, right there, the stock split, right? 14th of November to be specific. Moving into resistance right now. 1150 down to about 110. So 1150 down to 1100. I don't know why I say it that way. My apologies. That being said, weekly, clear weekly downtrend right now, which is synonymous with monthly consolidation, monthly candle close, not too good. If we come down to the 12, I will be buying my buy zones. I'll remind you, 1100 down to $1,000. Why? Because the valuation makes sense down there, but also management's guidance for 2030 for long-term shares should be $1 trillion in market cap. So I'm a big fan of building further share positions. I've been waiting for them. I didn't buy up here or here, but now that we're down here, I'm starting to buy once again. It all has to do with how extended you are from your EMAs. That's why I put so much emphasis on, yes, the fundamentals, but I want the fundamentals and the technicals to line up. That's when you usually get the best possible entries, right? Moving on to NVIDIA right now. NVIDIA down 0.2% after being up 2.5% on the Friday session. Might just be pulling back. Now, this move on NVIDIA looks small, but from the bottom to this top, guys, that's like a 20% move. That's not small at all. That being said, they have earnings coming up mid-November. So if you get some pullbacks, could be interesting to accumulate some more NVIDIA shares, play some short puts down here, or whatever you want to do in terms of the way that you go long, right? Moving on, weekly uptrend is nice. Get more consolidation, could be coming back down and retest our 190 lows. And the monthly is pretty extended right now from the 12 EMA. We didn't have that much monthly consolidation. Like it didn't come down that much. If somehow NVIDIA gets brought down after the guidance that they just gave us, $500 billion for the next 4 quarters, and the valuation as a result of that improvement in guidance, right? We're sitting right now at 200s at a 1.26 between a 1.43 peg as well. It's cheap. There's no other way to put this. It's cheap. So would I be investing in NVIDIA for the next 5-10 years on any significant drawdowns on this stock? Yes, because then the fundamentals and the technicals will be lining up, which gives us a better trade. Moving on to Tesla right now. Tesla up 4%. Doing some heavy lifting on Friday. Tesla did. Daily uptrend still nice. New daily higher lows are set 439.71. You can't lose this. If you lose this, you lose the uptrend. You just get buried back into consolidation, right? The bulls are trying to go for the upswing. They're trying to turn around this MACD and go for the big bullish breakout towards 500. If the SPY and QQQ consolidate, do you guys think Tesla's going to do it all on its own? Probably not. So this one is a case of it's beholden to index performance. That being said, the weekly is not looking too bad. Line in the sand on the weekly is 412. Why does that matter? You lose that, you lose the weekly uptrend, and you go into a bit of monthly consolidation. Decent monthly candle close, somewhat extended from the 12 EMA. Tesla does this a lot. They extend wildly from the 12, and then something always happens to where we pull back, right? Either Tesla specific or market specific. So pay attention to that. If it does happen, your support is 406 down to 383. Moving on to Palantir right now. Palantir's earnings Monday after the close. This stock is going to move 10% either direction. 10% up, you're 220, and very extended on the daily RSI probably. 10% down, you're back into the confines of the support range. I think Palantir is going to report very good earnings. The big focus is going to be on the revenue growth rates, both government and commercial, as it always is, to justify these very, very rich multiples for the stock. But Palantir's a story stock, right? The weekly looks good. Weekly breakout is confirmed right now. Nice back test of the 12. Nothing looks bad on the fundamentals. If you just forget the weekly RSI, if you just forget the monthly, if you just forget the fundamentals as well, right? The pure price action looks great. But if Palantir somehow shows disappointing revenue growth numbers, which would be surprising, you will start coming down. If the overall markets start coming down, Palantir has a chance to kind of get hit as well and maybe retrace back to the mid 150s. But I mean, we'll see what happens with earnings. We'll see what happens with the overall market. Am I buying Palantir here? No. Am I buying swing trades on Palantir up here? Neither. Moving on to SOFI right now. SOFI up 2.24%, but consolidation after earnings. Chart doesn't look bad, right? Daily uptrend, breakout, retest of what? Retest of resistance, which is current support. It doesn't look bad for some follow through, but you're going to need the market to stay healthy for that breakout to kind of follow through, right? If it doesn't, and it just keeps falling and erodes your daily uptrend and goes into a downtrend, you're looking into weekly consolidation. Higher lows on the weekly are down here, 24.68, a lot of space. If we pull back hard, I will be selling some put options down here, mid to low 20s, because that's your prior big support zone. Very nice, that prior resistance zone, very nice support. And you would just be looking for monthly consolidation, very extended from the 12th, very extended. Whenever it does get this extended, something happens, right? Something always happens, whether SOFI specific, overall market specific, right? It has run a lot. I will be a fan of playing this one, and I have been playing this one on and on and on the past few weeks, right? Past few months, selling short puts down there, never getting assigned. I wouldn't mind being assigned down there though. At 31, the valuation is not bad. If you're buying SOFI shares up here, you have a thesis 2027, 2028, 2029, 2030, right? Because if not, it's a very, very greedy short-term long when the monthlies look like this. Moving on to Uber right now, two last ones. Uber, not too bad. So Uber up about 0.01%. Doesn't matter. They have earnings on Tuesday. Stock's going to move about 7%. 7% to the downside. You will test this area of support once again. 93 to 90. The bulls really haven't lost this much in the last 3 months of trade. The weekly though, look, I mean, big up, small, big up, bigger retracement, move up, bigger retracement, move up, full retracement. If Uber somehow disappoints on earnings, we are coming down. The prophecy of the inverse head and shoulder, or the head and shoulders, will be fulfilled, and you're just gonna be looking for monthly consolidation. I would be a buyer though, because the fundamentals are pretty good. If you just blast off after earnings, then you're gonna be trading above $100, and as a result, your medium and longer term bulls will retain control. But in this market, I'm being very patient. I'm waiting for earnings, and if the numbers are good, but the market focuses on something bad, like Meta did, like Netflix did, I will be a buyer. But in this market, I'm waiting for after earnings to possibly position, right, on some things. Moving on to TSM right now. TSM also struggling at the highs right now. Triple top on TSM for now at 307. So that being said, lack of a follow through on the daily uptrend. Higher lows are here, 284. Flush that, you lose the daily. It'll be a daily downtrend and will be very healthy weekly consolidation. Now it's sideways weekly consolidation without a downward bias. If you lose some trends, you're going to go down to the 12 EMA right around here, 272. And on the monthly, I mean, the monthly is very stretched from the 12 EMA. TSM does this often. They stretch, they pull back close. They stretch, then something happens. It's always something, either TSM specific or something with the overall market. If it's the overall market this time, maybe we will find more buying opportunities on TSM 260, 250. And if this company pulls back with such strong fundamentals, I will be buying. But once again, I'm waiting for the good technical and fundamental setups to line up. That's when I know I'm getting the best possible price. Adding TSM shares up here with a very long-term time horizon, 5-10 years, and a plan to DCA, right, with paychecks, buy some here, buy some here, buy some here, buy some here. That's fine, right? Full send at these levels, you know, it's a very greedy trade. Even if the fundamentals are good, it's just a very greedy trade when a lot of these names have pushed and pushed and pushed on the weekly, overbought on the weekly RSI, overbought on the monthly RSI. It's just a very greedy trade. And greedy trades sometimes are fine, but if you do them, they should not be too large, right? There's always a trade-off, right? You can't be greedy and also go in full size and expect that it's a low-risk trade. It'll be a very high-risk trade. Some people can stomach it. Some people just hate it, right? that's everything I had for you guys for today's market rundown, earnings rundown, analysis, everything. All right, we don't have time for the biggest gainers and losers. We don't have time for my portfolio either. I will have to do them on Monday. I apologize, but if not, this video is going to be way too long. If you enjoyed today's video, it was a big one. It took me a long time to put together. If you enjoyed it, I really like that you guys like the video and subscribe to the channel. We're very close to 10,000 subscribers, and I need your help to get there. Last but not least, if you have any questions on today's video or just want to provide your perspective, please feel free to leave down below, leave a comment in the comment section. I'm always very happy to engage with you guys down there. And last but not least, if you guys are tired of trading and investing in the markets alone and you wanted to do it as part of a group with over 300 various members in which we trade the markets every day and build very robust long-term portfolios, you may consider joining our Discord service. The link to join is down below, and I have a promotion code, 30% off for your first month for Halloween. Promotion code is in the description, capital letters, Halloween 25. In the Discord, you get access to all of my trades in real time, the wheel trades, the leaps, a lot of further insights, right, on debit spreads, credit spreads, swing trades with shares. Here's just a lot of the trades that we've made recently. The green check marks are win, the red circles are losses. You guys know how that works. Always very transparent. You get access to our private morning live streams every Monday to Friday. I trade live and I take all of your questions on your stocks, your options, your long-term portfolios. You can also ask me all your questions in our chat rooms. I'm very fast to answer. And you get access to our educational section as well. Over 15 hours of various things like how to build a long-term portfolio, how to build a trading account, risk to reward setups, right? Videos on leaps, credit spreads, debit spreads, fundamental analysis, technical analysis. I don't know if I said it already, but the video is getting long. I'm getting tired, my bad. But so many different educational videos, which I won't put on YouTube. They're all there. And our members find tremendous value from that overall. And you also get access to all of my watch lists, right? All these watch lists that I use for the markets every day, my options watch lists that I use to trade options on things. And you also can copy all my charts whenever you see support resistance areas, right? You see earnings breakdowns, all things of that nature. You can just copy paste all of my charts. If you guys don't want to do it on your own and just copy everything that I have on hundreds of companies, you can just do that. Just an added bonus for our Discord members. And that's pretty much everything, guys. So thanks so much for watching. An hour and 50 minutes. I think this is my longest video of all time, but I usually make these videos. I mean, the earnings didn't help, right? But I usually make these videos very long when I notice that market dynamics are changing, right? So they don't happen that often, but when they do happen and I start changing my positioning from being full on the gas, full bullish, full risk on, I kind of pull it back. I figure that I should at least tell you guys that I'm doing that and let you guys take your own decisions. If you guys want to stay full on the gas, it's up to you. It's your money, not mine, right? If you want to drive your $500,000 Ferrari in the rain on summer tires, maximum speed because you don't care, it's completely up to you, right? But at least you have to acknowledge what the risks currently are for the market. That way, if something happens, you're going to know why it happened and how long it could possibly last before you establish some better buying locations, right? And this one, if it does occur or manifest, right, it may be more than just the good old 1 to 2 day pullbacks that we've been seeing recently. It may just be weekly and monthly consolidation, which takes weeks and sometimes like a month and a half to kind of sort itself out, right? So keep all that in mind when you're investing and trading in the markets in the near term future. That's everything for me. Have a good rest of your weekend, guys. And I mean, hey, one last thing. I could break down some people tell me, which is good suggestions, right? You should break down the first segment of the video, first segment of today's video, the analysis, and do one video. Then all the earnings, you should do that as one video. Then the technical analysis, you should do that one video. Well, yeah, but then I would post 3 videos in the day and the total length would be the same. And people would just say like, this guy's posting so many videos, I don't have time to watch them all. You know, why doesn't he just do it in one video? So there's like pros and cons to everything, but here you go. One massively long video. It is what it is. Thanks so much for watching. If you watch the entire thing, that's it for me. Enjoy your weekend. See you tomorrow. Peace.